Welcome. We'll give people a couple more opportunities here to get into the live stream and we'll get started. All right. Well, what you would like to talk about, just put it there in the chat and we'll knock it out in order. So whoever's first in the chat will take care of that. I'll leave the doorbell on so some people show up, we'll know they're out waiting to get in. Nobody's got anything. We don't need to do the overtime session. That'll be great. Nobody wants to talk about nothing. We got all your questions answered in the live stream. Make sure my audio is working. Reverse convertibles. Well, Jacob, you won't see reverse convertibles on the exam. Reverse convertible means the issuer gets to make you turn it into the stock. So that's no good, right? It's an embedded put provision. So I don't know what your question, Jacob, you won't see it on the test, but I would think heightened suitability. So does the customer understand that this reverse convertible means you don't decide to tell the issuer, I'd like X number of shares of stock? What happens, Jacob, is the issuer says, instead of giving you back your $1,000, Jacob, we're giving you 25 shares of our stock. And you say, well, I don't want the stock. I said, well, too bad. This is a reverse convertible. Now, we want to cut a reverse convertible some slack. I'm with you, Jacob. I was at a FINRA conference showing the flag for my firm, and this came up and they were describing this thing. And I thought, this sounds like a short put, and I'm the putee, and somebody can stick the stock to me. And they go, exactly. And I go, I get really upset when people give something a name that is obfuscating what it actually is. Now, the first clue would be, Jacob, that this might have a problem is you say, man, this reverse convertible lien pays me a lot more in interest than other bonds do. I said, well, yeah, it pays you more interest because you might end up with the stock and not your principal back. So the question was on futures, you're not, so this whole section on 65, 66 is called derivatives. Now on 65, 66, you're going to get questions on what are called futures. And so, there are forwards and there are futures. So one thing you get contrast on is forwards. I'll just make myself a soybean farmer in Iowa, and there's my soybeans that I'm growing, and I have my local grain elevator. And, in a forwards contract, what I can do is contract, two-party contract, with my grain elevator and say, in July, I'll deliver, 50,000 bushels of soybeans. And, then the problem with that is I have the risk they can't pay me. They have the risk I don't deliver. What kind of soybeans am I going to give them? So the first question is that futures are better than forwards. And here's why. In a futures contract, I don't have the counterparty risk. The intermediary will be the clearinghouse, right? So it's kind of like an option in that regard, right? The OCC, there's somebody in the middle. So the second test question about futures is how do we use them? So it's not like an option. There's not calls and puts. There's simply long futures and short futures. That's it. So I'm talking about soybeans. So if I think the price of soybeans are going to go up, I'm going to go long the soybean futures. And if I think the price of soybean futures are going down, I'm going to go short the soybean futures, right? I'm either going long or short, right? And if I'm right and the soybeans go up, I close out my futures contract for hopefully a profit. And if I'm wrong, it goes down, I'm going to lose money. So it's either long or short. And then the other question would be about speculators, or excuse me, hedgers. So what I mean by hedgers, I'm the soybean farmer. I'm afraid that the price of soybeans are going to go down. So what I'm going to do in the futures market today, what I'm going to do in the cash market later on, right? So if I'm afraid that by the time July comes, my soybeans are going to be cheaper, I'm going to short the futures on the soybeans. Again, hoping the price goes down and I make up in that futures contract whatever I'm going to lose in what's called the cash or spot market. Now, again, input or output, right? So if I'm actually buying soybeans and I'm afraid the price is going to go up, I'd go long the futures, right? So two couple questions on futures. And then what Brian was talking about and what the debrief was about was they got asked about this idea of the difference between a long and short in an option position. Remember, in an option position, you have either a choice to buy or sell and an obligation to buy or sell. That's not true in futures. You're simply long the futures or short the futures. It's two questions on 65, 66. And if you miss it, it's not going to be material to your success. So if you tell me you missed futures because of that, I'm going to say, I don't believe you, but let me just get a whiteboard here. So as I said, I can go long the futures or I can go short the futures. And so, maybe I go long soybean futures. I'll go for July. At 50 cents. 50 cents a bushel. Right. So if I go long the soybean futures there, what I'm hoping is the price goes up. And so maybe I close this out when I do my closing position, right? So I bought it. So the way I'm going to get out is I'm going to sell it. And I say I sell it and I sell it for 55. So this is I bought. Here I sold. And so then I made 5 cents. And if they ask you the contract, they tell you how many contracts. So here I made 5 cents. And maybe they tell me the contract size is 50,000 bushels, for example. So then I would simply take my calculator and I would multiply that. I'd say, okay, I made 5 cents on 50,000 bushels. So I made $2,500 would be the answer here. And I made the money because I was right about the direction of the futures, right? And again, if I were selling, I go short the soybeans. Here now I'm starting out with selling. And we do that 50 cents. Again, now that would be a loss if I close it out at 55. What I'm hoping here is when I close it out, I can do so at a lower price. I zoom. You're simply going to go long or short the futures. So if you sold the futures, you're going to close it by buying, and you're hoping there's a difference. And then remember the point with, bearish or bullish, exactly right. So if you're long the futures, you're bullish, and if you're short the futures, you're bearish, exactly right. And then remember, I just said that, maybe on a bad draw, you have to do a hedging transaction. So, let's say I'm Kikoman. Kikoman would be going long the futures if they're trying to hedge because they're worried about soybeans going up. Right. And if I'm the guy in Iowa, if I'm actually the producer, I would short the futures as the hedge. Because maybe you recall from that, remember it's the same with bullish or bearish. Hedging is about what if you're right or what if you're wrong. Right. Okay, so let's see. Yeah, well, STC, remember, STC isn't the test. I'd be really surprised if you saw anything on the test about reverse convertibles, but I would know the thing to know is there's an embedded put feature, and the issuer can put the stock to the issuer or to the bondholder. So again, that's what, in terms of suitability, the customer needs to understand that they may not get their principal back. They would get the stock. And obviously, if they're sticking the stock to you, that means it's worth less than the 1,000, because otherwise they give you $1,000. Well, the gist of straddles, there's 4 things you got to do on a straddle. I don't know if you're signed up for my class tomorrow, but it's called a straddle because we're straddling the strike price line. And so let me just get a price here. Apple's at 148, and I'm not really sure whether Apple's going up or down. I just don't think it's going to stay at 148. And so, you know, if I thought it was going up, I would buy a call. So I'm going to go buy 1 Apple July 150 call at 6. Right. And, you know, that's just a long call contract. My break even would be 156. I'd have unlimited gain, and I'm a bull. But as I just said, I'm not sure whether it's going to be good news or bad news. It's called a straddle because I'm straddling the strike price line. So, you know, I'm going to buy an Apple July 150 put at 6. So test question number 1 is, can you identify straddle? This is only if you're in Series 7. You know, if you're not taking Series 7, this is something you don't have to worry about. But test question number 1 is, can you identify straddle? Straddle is when you're long 2 different type of contracts. No, you will not see straddles on 65. So once you've identified as a straddle, what we're straddling is the strike price line of 150. The second thing on the Series 7 is, can you calculate the break evens? This is the only position where you have 2 break evens. Call up, put down. So my upside break even is going to be 12,162 is my upside break even, and my downside break even is going to be 150 minus 12, 138. And the third test question is, when do you use it? You buy a straddle when volatility is expected but direction's uncertain. And then number 4, or as I gave you number 4, so can you identify it? Can you calculate the break even? Where is it profitable? When do you use it? Those are the 4 test questions about straddles. Now, tomorrow, I'll be doing all the advanced option strategies. I'll be doing graphing and all kinds of stuff. But that would be what you need to know about a straddle. Basis points, yeah, basis points. So if you want to sound like a player, you would say bips. Bips. So let's start there. I don't know if I should tell you how most people get hung up. So let's start with a bond point, not a basis point, a bond point. A bond point is $10. You should definitely know that. And a bond point is 1% of par. Now, so half a bond point would be $5. A quarter would be $2.50. And you should certainly know that in corporates and munis, we're going to price it as a percentage of par. And the minimum pricing spread increment would be 1/8. Now, if you're hung up on that, you could take your calculator and take 1 divide by 8, and then you would times it by 10, the bond point. You would be able to tell me on the test that that's $1.25. And that's referring to the price of the bond. A basis point is talking about the yield, you know, and so a basis point is not 1% of par. You know, there's 100 basis points in 1%. So 100 bips equals 1%. So if we think about that, a 1 bip, if I said that a bond point is $10 in terms of price, that's actually 10 cents. Now, what you would have to do here, if you get this, I doubt this would be a big deal in your SIE, but here's an example, right? Let's say I have a bond with a yield to maturity of 8.5%. And let's say I have another bond I'm looking at that has a yield to maturity of 8.55. So what is the difference between those 2 bonds? What you would tell me is there's a difference of 5 basis points. 5 basis points. What's the difference between a bond at 8? By the way, the fancy word for a bond's yield to maturity is the bond's basis. That's the fancy word for yield to maturity. So the difference between a bond that has an 8% basis and 8.5% basis is 50 basis points. You know, what's the difference between a bond that has an 8% yield to maturity and a 7% yield to maturity? You know, if you say 1%, people are going to know you're not a bond person, right? Because it's not, you know, that's not how bond guys would say that. Bond guys would say the difference is 100 bips. 100 bips would be the difference. Now, Cynthia, I think you're taking the SIE. And the SIE, your other question here is tools of the Fed. And let's just get bigger than that first. You're definitely going to get tested on your SIE about fiscal policy, government spending and taxation, and who controls it. And the person that controls it is the Congress and the president. And you're also going to get tested on test question monetary policy, the money supply, and who controls that. And you would say the Federal Reserve Board. Now, the tools of the Fed, the one they use most often is open market operations of the Fed. So right now, the Fed has been tightening the money supply. So open market operations is the tool they use most often in terms of interest rates. And so right now, what the Fed has been doing is selling government securities. And when the Fed sells the government securities, they're shrinking the balance sheet. The money supply contracts, right? Because when there's, or excuse me, the money supply goes down, right? Because people are buying that. And so what you got to know is when they sell the government securities, when the Federal Reserve Open Market Committee sells the government securities, the money supply contracts. There's less money available, so you have to pay more to borrow it. It goes down, and interest rates go up. You know, the Fed has two missions. But one mission of the Fed is price stability, and the other is full employment. And right now, the Fed has been very forthcoming in saying right now we're more worried about inflation, price stability. And we're trying to dent demand. And the way we're denting demand to slow down inflation is by raising interest rates. Now, the rate they control directly, very testable, is the discount rate. So if anybody ever asks you about economics, finance, or investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. Somebody says, well, what about them? You say they fluctuate. Now, on your exam, on your SIE, you got to know where the money's coming from and where it's going to. So the discount rate is what the Fed charges member banks. It's the only rate they can control directly. The other rate they control or target, and that's what they do is target it. They don't set it, is called Fed funds. And there are test questions about Fed funds. Fed funds, of all the rates you're held accountable for, this one is the most volatile, meaning it changes the most often. It changes the most often. You know, the Fed tells banks how much they have to keep in their till to meet the everyday demand for deposits, right? So, you know, that's what they tell banks. If the reserve requirement is 10%, that's how much you got to have to meet your everyday demand for banking. And Fed funds is banks with excess reserves lending to banks with deficient reserves. That too is testable. And then the other thing we got to know is the other thing they would do, right, which is buy government securities. And that's what they've been doing for the last decade or so, is buying government securities. You know, during the financial crisis, the Fed's balance sheet was like $700 billion. And until recently, it was like $4 trillion. So they've been buying the government securities. And the test question here is if the Fed is buying government securities, the money supply goes up. And if the money supply is going up, interest rates come down. Loose money versus tight money. Now, the other two rates you should be aware of on your SIE is the prime rate. That's what banks charge its best customers. I don't think Fidelity has to borrow any money because they have plenty of it, but If Fidelity wanted to borrow money, they'd be able to borrow at prime, right? They'd just call Jamie Dimon and say, how much can you want? And poof. And then the last one is broker call, and that's used to finance brokerage accounts. That's what banks charge brokerage firms for money. So I would definitely know that. The other thing I told you they said is the reserve requirement, but they don't use that as often as they use the open market operations of the Fed. Is there anything else that you'd like to know about that? You can
That's perfect, Dean.
Okay, yeah, you can unmute too. I mean, that's the advantage of the Zoom. You're welcome to unmute. Okay, so let's see what's next. 1035 exchange, Jacob. What you're going to get asked there is you can't go from life insurance back to the variable annuity. The 1035 lets you go from exchange a life insurance policy, key point, life insurance policy, one policy to another, but you can't go from life to variable annuity or variable life to, or variable annuity to life. So that's what they ask about that. Erica, you're always wanting to do margin questions. Always want to do margin questions. So buying power is this 2 times your SMA. So if we buy 1,000 shares at 40 and we make the required deposit, so what you want to be able to do is on the exam, you want to be, if you're, again, this is only 7. And to be honest with you, Erica, you could guess B on every margin question. I think you're still going to be okay. But as you recall, we need to be able to do an initial setup. And then we got to do a mark to market. So the way we're going to do this is we need to know the classical margin equation. The classical margin equation. So I'm going to put you on the spot, Erica. Do you remember the classical margin equation? If so, put it in chat. Does anybody else remember the classical margin equation? It's long market value minus debit equals equity. So long market value minus debit equals equity. So debit register, debit balance is what you owe the brokerage firm. And so that is our classical margin equation long. I would definitely know that. I mean, they might just ask you to, recognize that as being the classical margin equation. So with that, now we can set this up, right? So we're going to have $40,000 in market value. And then they say something like the client makes the required deposit. So what is the required deposit in a margin account to buy $40,000 worth of securities? Yeah, very testable. That's called Reg T, and it's 50%. And that's set by the Federal Reserve Board. So that means this customer is going to have to put up 20, and we're going to loan them 20. So that's going to be his equity. And then we're going to loan the other $20,000. And that's called the debit balance. Okay, so now we have the setup. So where does this customer want the stock to go? Does the customer want the stock to go up? Or does the customer want the stock to go down? What does the customer want? Yeah, he wants to go up. So now they say in test phraseology, your customer buys 1,000 shares at 40, makes the required deposit. Several weeks later, the stock is at 50. And so now we're going to do a mark to market with the stock at $50 a share. And again, what we need to be able to do is the classical margin equation. So now the market value is 50. You still owe the brokerage firm 20. And again, I think the best analogy is the house, right? Market value of the house minus mortgage on the house equals equity on the house. So you still owe the brokerage firm $20,000. And equity always represents what you would have if you close the account. Nobody's suggesting you do that, but that's what you would have if you close the account, right? If you sell a house and pay off the loan, that's what it looks like. Okay, so we love to lend customers money. It's one of our all-time favorite things to say, do. I say, Erica, for customers like you that pick stocks that go up, we're willing to advance you a further loan. As you require, remember, Reg T is 50%. And 50% of $50,000 is 25. And so you only need to be at risk for $25,000 and you're at risk for 30. Another way to say it is I can advance you a loan of 25 grand on 50 and you've only borrowed from me 20. So Erica, you have $5,000 in excess equity. And just like a home, right? If you have excess equity in your home, a bank would be willing to advance you a further loan. They give you an equity line of credit, ELOC, and say, hey, just be careful. You write one of these checks. If you write one of these checks, your mortgage goes up. So Erica, what you could do with that $5,000 is you can have that as cash, or you can buy additional securities. My favorite would be buy additional securities. She says, Dean, do I have to do anything today? Now, if I told her she had to do something today, she might use that in a way that's not in her best interest. So I say, Erica, I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. I'm going to create a holding tank for your excess equity. Now, in the test, I don't think you would have any problem if you thought of excess equity and SMA as one and the same. They're not, but I don't think that would have any problem. So you can have a SMA as cash. So I'm willing to send you right now a check for $5,000. Or if you'd like, you can buy some stock, and I'm willing 2 times. I'm willing to lend you $10,000 if you want to use it in our catalog to buy additional securities. Now, again, this would be a, hellacious draw on the exam, but, they might say your customer buys 1,000 shares at 40, makes the required deposit. The stock's at 50. Which of the following is true? Which of the following is true? And then the choice A says the debit balance changes. And, choice B says they have SMA of 5 or buying power 10. Yeah, ding, 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 ding. Or they might say all the following changes except, debit doesn't change. Yeah, always excess equity. 2 times your excess equity is always your buying power. This is only on 7. There's only 3 or 4 margin questions. So Eric, I put a margin class on the Setmore page for $60. And the only reason I did that is I have people using Past Perfect who have literally spent hundreds on tutoring with me to do Past Perfect margin questions I don't think they're actually going to see. So I thought, well, heck, maybe they spend $60 and, they can do their margin questions. Go. Well, don't overdose, Erica. Don't overdose on it. And then remember, you get free repeats. I don't know if I put that disclosure in there, Eric. I think I did, but if not, I'll put it in there and say, listen, you don't need this. It's there if you want to have a comfort level, but I don't really think you need to, if you come back and say you missed the mark because of margin. Now, I do know that I know Erica's using Past Perfect, and oh my God, they just, and I know that some companies won't let you, using Past Perfect, won't let you go to unit 19 unless you pass unit 18. If that's margin, it's Past Perfect. Oh my God, you could be stuck there forever. So, we've joked, maybe I should just call that the Past Perfect Margin Support Group, $60. Anything else? Let's see. Anything else? Did I miss anything? And then remember, Eric, it'd be the same thing short, except remember the short equation with the classical short equation would be credit register minus short market value equals equity. So that's the classical margin equation. You're definitely getting asked about minimum maintenance, right? Minimum maintenance is 25% long, and minimum maintenance is 25% long, 30% short. Tax on partnerships. Well, remember, there's a flow through. So, here we go. So there's Dean's tax return. And so we don't really care about this. This is my paycheck income. This is me working for money. This is my portfolio. That's my money working for me. And then my partnerships is called passive. So that's my distributions from my partnership. So if I'm a limited partner, I'm going to get what's called a K1. And that K1 is going to say that in the partnership, I either had a passive activity loss or I had a passive income. So, it's going to flow through to me as an investor. And so the first test question about partnerships and taxation is the profits or losses flow through to the partners. There is no retained earnings. The Golden State Warriors is a partnership. And that means there's no retained earnings. The partnership has a profit or loss and it flows through on what's called a K1. Now, I can't use passive activity losses from my partnerships anywhere else. So passive activity loss, PAL. So, maybe I went into oil and gas, wildcat program, exploratory program. And let's say I invested $50,000 and I lost $50,000. Now if we over here in this part of my portfolio, right, and I had lost $50,000 in my portfolio, my unearned income, I could take 3,000 of that against my paycheck income, right? So I made 95. I could say I made 92, but one thing here, as I just said, is whatever happens here stays here. So I can't do anything with that. So what I would do is find a partnership, hopefully, that would throw off some passive income. So what I would try and do is match that up with a partnership that is distributing to me passive income. And then that leads into a discussion of various types of partnerships. I need a passive income generator. I made one time, Eric, I made a $24,000 commission. And it was a doctor, and I was trying to get him to invest in this partnership. And, he said, Dean, I'm going to take a pass. He says, it's embarrassing, but I've got all these partnerships with all these losses. And so the last thing I need in my life is another partnership. And I said, well, doctor, as you know, all those partnerships you have, you just told me, are throwing off passive activity losses. And so I think you need to make a bigger asset allocation because this throws off passive income. This is an all cash partnership. And so the distributions are going to be cash, and you can collect in your situation, if it's the one I have on the whiteboard, $50,000 in cash and have no tax consequence. So, we want to match a pig with a PAL, a passive income generator with a PAL. Or maybe I call Erica, I say, Erica, we have a lot of passive income. And, it's over there and it's, in that passive area. I would like to recommend we go for an oil and gas exploratory program. Get aggressive, because even if we do lose money, we're not trying, but if we do, we can use those passive activity losses against our passive income. I wouldn't get too much into the weeds about cost basis and recourse and non-recourse notes. Again, partnerships and margin, both, Erica, both of the things you wanted to talk about are the two biggest areas that trust prep vendors go total overkill on. Whether it's Kaplan or STC or Past Perfect, they do way too much on margin and way too much on partnerships. You're going to get 2, 3. As I mentioned, the old days, there were more like 10 or 15 partnership questions. And then again, nobody wants to call their Q bank. So everybody still has these legacy partnership Q bank questions. Let's see. Out of state OIDs bonds. Well, you're not going to have to do practical application, Jacob, but an OID, also known as a zero, you're going to have to recognize that you have to do straight line amortization upward. So I'll just give you an example here. And so I buy this thing at 500, originally at a discount, and it's going to mature for 1,000. I'm not going to make you on the test, do the math. Let's say it's a 10-year zero. So I'm making $500. And I'm making $500 over 10 years. And so what I have to do is a straight line amortization upward called accretion. So if I take that 500 and I divide by 10, I'm going to accrete $50. So, first year I'm going to say I made $50 in interest income. That's not actually true, but that's kind of what it sucks, right? Because I'm going to claim $50 here in that first year. And it sucks because I'm paying taxes on money I'm not actually receiving. So in this example, there's an imputed interest I'm receiving of $50. Year two, 600, all the way up. So at the end, I wouldn't have anything to do that. And that has a name, paying taxes on money you're not actually receiving. Anybody know in chat what that's called? Paying taxes on money you're not actually receiving. Yeah, so this wouldn't be a good recommendation, Jacob, and somebody with a high tax bracket. Now, if this is a general obligation, oh, my bad, Jacob. If this is a muni bond, that's the issuer. If this is from, Clark County is my county here in Vegas, that imputed interest is still calculated, but it's not taxable. So that would be the difference between a no ID or zero coupon bond that comes from the US government or a corporation versus a muni, right? So yeah, it's called accretion, Now, the other thing on a muni bond, I don't think on a muni bond, Jacob, you're going to have to do upward a thing called accretion. 50% probability you're going to have to do downward amortization called decretion. So Jacob, if you buy a muni bond at a premium, you're going to have to do straight line amortization downward called decretion. And that you might actually have to do. Anything else? Now you guys could totally booked up this overtime session. So I know Erica's already signed up for next Tuesday, but remember we were capping it at 10. So if you plan on participating next week, it's a 45-minute session. So you got a few minutes, Erica. So what do you want to do a break even on? I'm not going to be, there's 9 strategies. We're not going to have time to do break evens on 9 option strategies. Do you have a particular break even you'd like to see? No. Straddle, okay. So as you recall, I had a straddle of Apple up here. No, if I really wanted to teach you options, I'd make you buy one. And once you were out of pocket, you'd figure out pretty quickly how this game works. So I said, Erica, this is the only strategy in which we have 2 break evens. And so the way we're going to do this is we're going to combine our premiums. Now, there's a lot of ways, lots of ways to do options. I like to use a T, and I like to track the money in and out. So I say, okay, I paid 6 for that. I paid 6 for that. Break even is always expressed as a per share number. If you only remember one thing about options, the thing I would tell you to remember is call up, put down, call up, put down. And so I'm going to have to cover my out-of-pocket cost here. And my out-of-pocket cost is 12. Now, if we look at the price of Apple, here is the price of Apple. The price of Apple could be anywhere from 0 to infinity. And what we're straddling is the strike price line here, which is 150. And so, boom, let's put that there. So I'm going to need at least 12 points up or 12 points down to break even. So the way we get our break evens is we take strike price plus total premium, and that gives us our upside break even. We said this is the only one in which you're going to have 2 break evens. I'll put it right there. And so our upside break even is going to be 162. Right? My strike price is 150. My combined out-of-pocket cost is 12. And so I get my upside break even of 162. So I need the apple to go above 162. You know, by the way, I'll just illustrate it. If I buy the apple at 150, which I have a choice to do, and I sell it at 162, I would have the same dollars out as in. I'm just illustrating that indeed that's the break even. Nobody does things at break even. So I need 12 points up or I need 12 points down. Right. So the way we get our break even on the downside break even, again, call up, put down. It's going to be strike price minus premium equals my downside break even. And so let's put that over here. And I'm terrible at arithmetic, so I'm not being facetious. I would take my 150 minus 12, 138. Now, the good news, I'll also have numbers available to you to choose from. So that's kind of, that's my downside break even. I'll just prove it. I have a choice to stick the apple to somebody at 150. And so if I buy the apple at 138 and stick it to somebody, I'd make 12. By the way, I'm a big believer that what you should do is under these contracts is write what you're looking at. You're looking at a choice to sell the stock at the strike price. That's what that bottom leg is, right? And this is a choice to buy. And so your answer on the test would be the break even in the straddle is 162 and 138. Well, if we close it out in intrinsic value, so we can do that. So let's say Apple's at 170 and I close out at intrinsic value. Now, one trick is just to compare that and say, well, that's 8 point, whoa, gee, what happened? Where did my board go? There we go. It's going to be an 8 point profit. But if I want to show that to you, which I'm going to, so let's get our annotation tool going. I need to clean up my board here. So the intrinsic value, by the way, the phraseology is testable. So the intrinsic value of a 150 call with the stock at 170, that's going to be 20 points. So we're going to close that out. By the way, it doesn't matter if you memorize, you'd get the same answer here. But right, that's what we did there. This one expires. And so that means, again, now I just total that. I have 12 points out and 20 points in. So I made 8 points. Well, I told you suitability. Suitability is somebody who's expecting volatility on Apple. You know, I'm expecting Apple to go way up or way down. So that's that fourth thing. There's 4 questions about a straddle. Now, tomorrow I'll be doing all of this at length, but can you identify the straddle? Can you calculate the break evens? We just did that. Where is it profitable? Right. And then we've got a great mnemonic for that. So, you know, it's not what Erica asked, but the mnemonic for that, for profitability, come on, is silo. And that stands for short inside, long outside. So we want the apple to be above 162 or below 138. Right. So then we're a winner. We just did 170 and we made money. So we wanted either above or below that. And we're a loser if it's between there, right? We don't want to be a loser. We want to be a winner. By the way, when this dawns on you, you have half as much to learn. And for the short, it'll be the opposite, right? If you're short to straddle, you would want it in between these two numbers. You wouldn't want it to be outside those two numbers. Short straddles have unlimited risk. Well, Ray, I hate to tell you, but it's 7 o'clock. So the session is over. Ray, did you already sign up for next Tuesday?
Not yet.
Okay, well, just do that. And then just remind me in the chat that you're first to go. Are you not testing? Are you testing this weekend? Or you're not testing, are you?
Unfortunately, I'm kind of in that Kaplan where you have to pass certain, the things that are not heavily covered. So they
Oh,
won't
okay.
schedule me until I get that.
Oh, so you're stuck on orders?
Well, I'm stuck on like the options and
Okay.
the
Well,
ones
what
and
we'll
stuff like
do
that.
is just quickly, so let me just go quickly. Overtime on the overtime session. There's only two types of orders. I think that's where people get hung up. Now, the two types of orders are market orders and limit orders. Now, granted, there are a zillion subcategories you can add to an order, but at the end of the day, it's either a market order or it's a limit order. CMP means current market price. And right now, the current market price of Apple is 148. And so, you asked about stop orders. The number one use of a stop order is to stop a loss. And so we have two types of stop orders. We have sell stops, and we can have a sell stop that turns into a market order or a sell stop that turns into a limit order. It doesn't matter. All sell stops have to be placed below the current market price. And we have buy stops, and those have to be placed above the current market price. Now, it doesn't matter, again, whether you want to turn it into a market order. When we pull the trigger, it's the only order that has a trigger. It doesn't matter when you want to pull the trigger and make it a market order or a limit order. Whoop, it goes above the current market price. So that's our first test on where do we place orders in relationship to the current market price. And we put buy stops and buy stop limits go above the current market price. And it would be foolish to put a buy stop limit because then you may or may not get execution. And you put this here. As I said, the number one thing to do is to stop a loss. So let's just get some test phraseology here. Your client buys 1,000 shares of Apple at 148. Buy 1,000 shares of Apple at 148. So what am I afraid of if I buy 1,000 shares of Apple at 148? Am I afraid of the stock going up, or am I afraid of the stock going down?
Down.
Yeah, so I'm going to tell my broker I'm only willing to lose approximately $3,000. And so I'm going to say to my broker, I'd like to put in a sell stop at 145. I want to stop the loss, stop the bleeding. Part of successful investing is letting your flowers bloom, but more important, pulling your weeds. And this is an automatic weed puller. So now if Apple trades at or through 145, it gets triggered, two separate events. And my broker calls me, said, Dean, your sell stop got triggered at 145 and you sold the Apple stock at 144. And so I lost $4,000. I stopped the loss. That is important to know what we're using this for is a stop loss. Now, Ray, next Tuesday, if you want, I'll show you a sequence of trades, and that would be the other version of this, where I show you a sequence of trades on the test. And I ask you, did it become a live order? Now, if you're just using a limit order, if that's all you want, not a trigger, you just want to be able to buy it at your price or less. That's just a straight old sell limit. Customers get hung up. Nobody has to do business with you at your price or better. That would be above the market. That's not a stop. That's just where you say you want to buy it at your price or better. I'm building a memory aid device that's worth a lot of points here. I would hope that some of you can already recognize the memory aid device that Dean is building. Anybody know what this is building here?
SLOB and BLiSS or BLiSS.
Yeah, that's right. SLOBS over BLiSS. And that's to remind us where we place orders in relationship to the current market price. So if all you want is your price or better, that's not a stop order. Right? If you just want to buy Apple, you don't own the Apple already. You say, Dean, Apple's at 148. I want to buy it at 146 or less. That's a buy limit. Right? If you say, Dean, if it trades at or through 150, I want to buy it. That's a buy stop. So I think that's, it's easy to get confused. I know you're not surprised, Ray. I have a evening course. I think I'm charging for this one type of orders. I don't know what I'm charging. I think I'm charging 40, 50 bucks. But you get the free stuff too. I don't mind doing it free in the Tuesday session. Did you, Ray, sign up for a class yet? Have you spent any money with me at all?
Not yet.
Okay, well, you don't have to. I'm just saying that the office hour that Erica doesn't want to share, that would be another time I could do this. So hold on, that's Mom. I got to answer the phone. Yeah, Mom. All right, see you in a bit. Bye-bye. So Ray, I'm not telling you have to buy the course. I'm just saying that if you were, then you could participate with Erica in that office hour session. Or like I say, just remind me Tuesday and I'll give you some examples of this. All right, anything else? Please don't. Okay, well, listen, thanks for participating. If you want to participate, this got booked today. We hit our 10. So I don't know if Tuesday is already booked. I think Erica's on it, man. Erica, this is a test question. Erica is a front runner. She's trading ahead of everybody. I'm joking. There's no ethical problem with that. But if you want to join us next Tuesday, and then Ray, just remind me, and I'll make you first. And the only thing I didn't show you here, I'm rushing because Mom's on her way home and we got to have dinner. But the thing I didn't show you is like a sequence of trades. We could do some more with this certainly. So if you sign up for next Tuesday's overtime, just put in the chat that I said you'd go first, and we do types of orders out of the gate. All right, anything else? Impinged to Dean. I'm not sure what that means, Jacob. Oh, you signed up? So again, so remember, I'm figuring this out as I go. So you guys are kind of my focus group. So the way it works, this is what I'm thinking. And again, it is evolving. So don't hold me to this. But as I have it set up right now, we're doing the overtimes, which are free and capped at 10. There is no cap to somebody who is paid for a class, right? So even if Erica went to register next Tuesday, she already has, but let's assume she didn't. And she calls me, says, Dean, it's telling me there's no slots. I would just manually stick her into the overtime. So there is no cap to somebody who is either paid for a class or tutoring or whatever the case may be. You also get free repeats on the class. So if you, Erica did, for example, some of you guys joined me for basic option positions. I'll do that again. I'm gonna do it like every 6 weeks. I didn't have the timing on that one down because it's, again, I teach it all the time, but I haven't done it in an evening version. So anyways, we'll do it over again, and we'll do them all every 6 weeks or so. And you would also get free repeats. So if you aren't participating, Ray, in a paid something class, there's still free stuff for you, but it's mainly going to be the overtime session is the main thing that's available as a free thing for somebody who's not bought a class or paid for tutoring. So that's kind of my idea on it. And, we'll certainly get you some help. So, but that is definitely free with no cost or obligation. Any other things? Well, Thursday, Erica, is your office hour. I'm not sure if that's what people were talking about on live stream. I said there's nothing on Thursday, but that's because most of those people in live stream don't have the access to the office hour. No, work is the last refuge for people who have nothing better to do, and I do. So unfortunately, again, as I told you, Eric, I'm trying to keep this at a level that I enjoy because I don't think of myself as a full-time person. I'm a semi-retired stockbroker. And Eric, I don't want to come out of retirement to be doing Tuesday and Thursday nights, free stuff. That doesn't speak to me. I'm giving you plenty for free on the channel. I've got this overtime session for free. And, I'm not willing to commit at this point 2 nights a week. So who knows, maybe that will change, but I wouldn't count there's going to be a Thursday night live anytime soon. Tuesday night, overtime, office hours. Eric, if I did increase anything, it would probably be an office hour once a week instead of every other week. So that's kind of the plan. And then I'm trying to do as much as I can the first quarter because I also teach Kaplan classes once a month. And I took the first quarter off to work some more on the channel, but second quarter I'll be doing classes. And I do 1 Kaplan class a month. I do the SIE the first month of each quarter, or 7. And then I do the 66 the third month. And so I'm not going to have quite as much time as I have now. All right, anything else? I should, Dean. I don't know what I should do, Jacob. I'm not quite sure I understand the chat. All right. Please send to me an email. What am I sending you, Eric? I'm not sure what I'm sending you. You can unmute if you want. I'm not sure what I'm sending you. Oh, this video. It'll be on the channel, but I'm more than happy to do that as well. So, Eric, if you want your own personal copy, that's fine. So let me stop the recording. Thanks. That reminds me to stop the recording.